in with a sense on how the market is set up. Mitesh, hi, good afternoon. Good to have you with us here. How are things looking now? We are down firmly, pretty much the same picture the last time we spoke.
That's right, Prashant. Good afternoon. It's not actually moved much. It's moved down and then, turned sideways. If you look at the last 2 hours of data, hardly any movement has taken place. So while the good thing is that it's not breaking below 17,700 conclusively, the bad thing is that it's not even trying to move up. But we are still trading with long bias, given the fact that a lot of stocks are showing promising patterns on the daily and the intraday charts. And I think, that's where momentum could be in case the market doesn't fall much. These stocks should do much better than the rest of the pack and possibly record some gains. So I have a buy on Siemens. It's done very well to move nearly at the day's high, and would recommend a buy here with a stop just below levels of 30.43 and a target of around 31.50 on the upside can be looked at. The other one which is reversing is RBL Bank. The stock had outperformed for quite some time in the month of January, late December and early January, and then we saw a correction. It's now reversing after completing the correction, so that's a buy as well. Keep a stop at about 158, look for targets of 175 here.
Okay, thank you very much for that. Let's talk a bit about Divi's laboratory. The stock crashed on Friday after the numbers came in much lower than street anticipation. There was a big margin miss, and it's followed it up with another bout of selling, 4% lower now. Ekta standing by to tell us what went wrong for Divi's laboratory in this quarter and what the outlook is. Ekta.
Divi's Labs margins were the key disappointment in Q3. The company, which was once lauded for its margins sustaining at over 40%, reported margins which were at a historical low of 23.9%, led by factors such as cost inflation and pricing pressure this quarter. Also saw the impact of COVID-19 opportunities such as molnupiravir depleting. Estimates are Divi's made as little as $5 million of sales from molnupiravir versus $130 million a year ago and around $40 million just last quarter. And besides COVID-19 opportunities depleting, the company was also impacted by the underlying profitability in the generic API business being impacted due to price pressure in the US markets. Some products, in fact, faced anywhere between 5 to 10% price erosion. Brokerages were clearly disappointed with this quarter, with target prices reduced and EPS estimates cut anywhere from over 10% for FY23 to over 15% going into FY25. The street fears earnings to be impacted more than earlier due to a high base in the custom synthesis segment, price pressure in the US, and an overall reset in margin expectations. Lastly, what could help turn the stock around? A few triggers include the Kakinada capex for the company coming on stream, for which the company did get a green signal to resume construction, recovery in margins, price pressure in the US, and some opportunities coming through in other segments such as contrast media as well as fast-track projects. And valuations. Once the darling of investors, the stock has already lost over 40% from its 52-week high and is now trading at around 35 times FY24 PE, which is a far cry from the peak of over 70 times, but still expensive, according to some.
All right, Ekta, thanks very much. That's a comprehensive take on what's gone wrong with Divi's. But